What's up, everybody? This week we're going to talk about a guideline that I think is very important to share, as there's times this guideline can help you save a deal, and not a lot of people know about it from my experience. Assets as a basis for a repayment of obligation. It's a Freddie Mac guideline using assets for income. Now, Fannie has a similar guideline, but it's not the same. So if you have to go DU for some crazy reason, there's separate guidance for this, and we'll discuss in weeks to come. You might ask me, assets for income. What you talking about? So today we are discussing how you can possibly use a borrower's assets as qualifying income. We will first talk about the guideline and exactly what type of borrower qualifies for this. Then I'll give you an example of a simple math one. Let's dig into the mortgage eligibility requirements. The asset described in section 5307.1 may only be used to qualify the borrower if the mortgagee meets all of the following requirements. The mortgagee must be secured by a one or two unit primary residence or secondary home, so no investment properties. The mortgage is either a purchase transaction or a no cash out refi, so you cannot do a cash out on this guideline. The mortgagee has a maximum LTV or loan to value of 80%. And then the HELOC loan to value is also at 80%. At least one of the borrowers who's on an account owner must be 62 years old. Now let's dig into how to calculate the asset for income. To determine the amount used to establish the debt payment to income ratio, the seller must use the net eligible asset and divide it by 240. The amount of the net eligible asset is calculated by subtracting the following from the total eligible assets: any funds required to be paid by the borrower to complete the transaction. So if you're using some of the asset, for example, if you have a $400,000 asset and 100,000 of it is going to come from the down payment of that asset, you have to subtract the 100,000 from that. Any gift funds and borrowed funds. So it can't be any gift funds, or they can't go to the loan and borrow any funds that are like $1 million and use that as the asset because that's not legible. Any portion of the asset pledged as collateral for a loan or otherwise encumbered. Now we need to take a look at the allowable assets that Freddie will let us use. First asset type we are going to discuss is the retirement asset. This can be a 401k, an IRA, etc. It must be owned solely by the borrower, and the borrower must not be drawing any other source of income from this asset. You have to also use the net asset, and it must be fully vested amount. The accepted documentation requirements are pretty simple on this one. Most recent retirement account statement and documentation from the bank that all the asset eligibility requirements are met. In other words, the terms of withdrawal. Another asset type that we're allowed to use is the lump sum distribution not deposited to an eligible retirement asset. This asset has to be recognized by the IRS, and it must be deposited into a non-retirement asset like a checking or a savings. Lender cannot have any interest in the asset. Basically, your LO cannot be on the asset. The proceeds must be available immediately, and there cannot be any tax penalties or early distribution taxes. Let's get into the documentation requirements for this. Proof of receipt of the asset and a 1099 form. And then we will need to prove that the funds from the asset came from a retirement account to a non-retirement account. And the lump sum distribution funds were not taxed. Now we get into a fun one, liquid depository accounts, basically your checking and saving accounts. Let's dive in. The borrower must be the owner of the account solely. At least one of the borrowers must be 62 years old. As of the note date, the borrower must be able to withdraw the assets fully. Must be located in the U.S. and it must be in dollars. Now, the type of documentation required is an account statement or 1 or 2 months. But in the account statement, the underwriter needs to look at a few things. We must document the source of funds for any deposit exceeding 10% of the borrower's total eligible assets in depository accounts and verify if it wasn't borrowed funds or if it wasn't gifted. I want to walk you through a quick example of how to calculate the income. Let's say your eligible asset is $500,000 and the down payment is $200,000 and the down payment is coming from the asset. So what we would do is just subtract 500,000 minus 200,000, which will get us 300,000. Then we divide the net asset by 240. So it'd be 300,000 divided by 240. Your monthly income will then be $1,250 a month. That's it for this week, guys. Please make sure you guys like, subscribe, and share my content if you think this content will help someone else. You guys have a good week.